Basically today, I want to dive into why you should check into index funds as a part of your overall portfolio. If you don't know what an index fund is, I suggest you do a little research on a company called Vanguard. Check out John Bogle, aka Jack. He recently passed this year, and pretty much the father of index funds, and probably did more for the average investor than any other person. Huge hat tip to John Bogle and Vanguard for lowering investment fees for the average investor and really making it possible for you and me, people like us, average people, to retire comfortably, cutting through the crap out there, all the bad financial products they have on the market, all the scare tactics, and all the people claiming they know what's going on, where the market's going to go next, and stuff like that. Basically, an index fund is a collection of the top companies. So take the S&P 500, for instance. I think there's like 506 companies in it right now. But it's basically a collection of the U.S. top companies. So once you invest in an index fund, there's a few benefits right away. Number one, you're instantly diversified. So rather than picking individual stock where you have a lot of risk if that company does well or if they underperform, you're going to have outsized gains or huge losses. By investing in an index fund, you're diversified across all of those companies. And instead of a huge swing one way or the other based on one company's performance, your risk is spread across the top 500 companies in the U.S. So basically, you're betting on the U.S. economy to do well. I heard some crazy quote from Warren Buffett. He's a big proponent of index funds. And it was something like, if he had invested $100 back in 1942 when he bought his first stock, today it'd be worth, I want to say, $10 million. And what's crazy about index funds is it's truly passive income, because an index fund pays dividends just like some stocks do. So your growth is not only increasing over time with the performance of the companies, but you're also getting dividend payments, which can then be reinvested automatically. So it truly is a set it and forget it type situation. Early on, I had no financial education and basically tried picking stocks, doing penny stocks, tried buying commodities like gold and oil, thinking I was smart. But really, the key is just capturing the average of the market returns over time. If you can do that at low cost with a high tax optimization, that's all you need to become a millionaire. And I started investing slowly. Basically, I put 5% in when I started my job in the factory at age 20. Over time, I bumped it up a little bit, but I'm currently around 30% is what I put in. And I do find that sometimes when the market's diving, I'll increase that rate just because I want to get more at the lower price. But you never know how far it's going to dive or how high it's going to climb. So I think the key is to just always be investing And my plan is to never have to sell my index funds. So I'm hoping for, residual income for myself and my family in the future. There's a cool rule you can look up. It's called the 4% rule. Basically, it states, you can safely withdraw 4% of your portfolio without ever drawing down the balance. So you can live off the interest if you only take out 4% per year. So if you think about that, there's a couple ways you can think about it. If you have $1 million portfolio, that's telling you you can live off $40,000 a year and your money will never decrease. Or you can think about it from the other way. Say you need $40,000 to live, you can multiply that by 25 and basically get your freedom number. So that's what I did. And what you learn from doing that is minimizing expenses is an important thing to be cognizant of, because that helps you. It's kind of a triple bang for your buck. You're minimizing your expenses, which that means that's giving you more money to invest. And it's also requiring less money that you need ultimately in retirement. So it means that your freedom number is smaller. Basically, I hate how there's not much financial education out there. It's not pushed because obviously financial advisors, the financial industry is just making money off us with all their fees, unnecessary fees. You want to cut those people out of your portfolio. So there's something called an expense ratio inside your index funds or any mutual fund. You can look that up. I'll show you in another example sometime. But basically, you want to keep that expense ratio as low as possible, because when it's high, that's money that you have to pay just for it being invested. Some of mine are like 0.0025 or something crazy like that, because John Deere must have had someone who knew what they were doing when they were negotiating. And a lot of these places have also, since Vanguard came out and kind of put the investors first, have to start lowering their fees to maintain customers. So that's awesome. But I know a lot of people probably have no idea what the expense ratios are that they're paying. And even like a 1% expense ratio is super expensive over a lifetime. So if you're thinking, 1.25% versus 0.25%, it's not much of a difference. Really, over a lifetime of investing, that can cost you $200,000 or more. And I looked at my mom's, at her work, some of her she was invested in was like 3%. So it's real crazy, guys. You need to pay attention to this stuff. I'm going to show you just a short video of how mine did over the last 2 years. This is just index funds. So I invest automatically out of my paycheck, reinvest the dividends, and it just grows passively. So you can see back in October 2017, I started around 63,000 and kind of grew over time. You can see it hit a dip here. Now, the problem with most people is they'll panic when it gets to that low spot and they'll start selling. Then they end up missing the market gains when it rebounds and they go in and buy higher. And that becomes a problem because if they had just left their money invested, it's going to do much better. I can't remember who it was. I think it was J.L. Collins, but he was talking about different groups of people in a study that Fidelity did, and who performed the best. And it was actually dead people that did the best over that time period, because they're not touching their investments. Everybody else panics. They're too irrational, too emotional. And instead of being an investor, they try to time the markets, think they're smarter than the markets. And don't get me wrong, I did plenty of that before I finally wised up. But just wanted to hop on here quick, give you guys a little hint of some of the stuff I'm going to be talking about in the Money Makeover Challenge. I'm going to dive in deeper on index funds,